Hi, everyone. I'm going to just make a couple of opening remarks to frame this. We of course, welcome, Roy and I welcome Al here to present his research. We think it is an insightful beginning to understanding the relationship between complexity in markets and complexity of instruments and complexity of agent portfolios. So if one were to think about liquidity risk in terms of debt capacity, and if one were to then think about debt capacity as being a function of a particular firm's set of contingent obligations and its contingent value of its assets that it's using as collateral, you've got a lot of interesting interdependencies. I also have the world's smallest teleprompter this evening that I'm using with my notes. So the things I'd like to get across is that instrument-specific, what we often think of optionality, state dependence, path dependence of instruments or securities, and agent-specific complexity, which is the portfolios that agents hold, and then the obligations and rights they have between each other are related. The work of Brunnermeyer and others somewhat talk about this, but I think Alp's work fleshes it out a little more in a way that I find interesting. I think we find it interesting. Both agents and instruments exhibit, as I said before, state and path dependence, and that results in heterogeneity among agents. Agents are different in their characteristics, and their characteristics continue to change and evolve over time, sometimes slowly and sometimes extremely rapidly. And so, from my own research, that's endogenously manifested and dynamically manifested by a risk-based leverage, which ultimately affects market clearing and the market price of risk in the aggregate or at the market level. So just to summarize, there are bilateral agreements. Those bilateral agreements can be state dependent. The trading histories of firms can make them path dependent as well. And so with path dependent histories, search becomes complex. There are networks that are constantly evolving and changing, and sometimes very rapidly. And agents have to solve that problem. And so you have to ask, you were a computer science major undergrad, right? So what's the computability of the problem is what you're thinking, right?
I think it's degree order of magnitude harder than for computers to solve.
I think that's correct. So why don't we, interesting, we had and this is my last thing, we had a panel a few years ago with Sandy Grossman, Steve Ross, and Myron Schultz. And all three of those panelists were thinking about the plans of agents or the plans of institutions or the plans of traders. And in fact, I think Sandy was the one that kept using the term plans, and how it's very difficult. There's a bottleneck in terms of updating plans and modifying plans that result in these episodic events in the market. So now we're going to learn more about that from you. Thank you.
Thank you very much, David. And let me start by apologizing for my outfit. I forgot to pack my suit, but at least I brought my presentation, which is titled Sources of Uncertainty in Financial Markets. Now, we're going to come to the issue. Thank you very much for the excellent introduction. We're going to come to those issues about complexity. But let me start with a slightly broader issue. So I'm going to talk about two pieces of research today, one in more detail than the other. And both of them will be about uncertainty in financial markets. And the starting point of this research is my contention that uncertainty is very important to understand financial markets in various aspects of financial markets. Of course, there's much previous literature on uncertainty, and much of this previous literature is focused on the effect of a given amount of uncertainty on asset prices and investment decisions and so on. A strand of more recent literature tries to understand where does uncertainty come from, the sources of uncertainty. And the papers that I'm going to talk about today could be understood as falling into that strand of the literature. And the first paper I'm going to talk about, titled FireSales in a Model of Complexity, which is joined with Professor Ricardo Caballero from MIT, who couldn't make it today. This paper is precisely about the issues that David raised excellently earlier. So we're going to talk about complexity as a source of uncertainty and how agents' inability to deal with complexity in short amounts of time will generate uncertainty and how it will affect market allocations and prices. And the second paper, which I'm going to briefly talk about, is titled Speculation and Risk Sharing with New Financial Assets, And in this paper, I emphasize financial innovation itself as a source of uncertainty, and I look at the implications. So for the work on fire sales and complexity, the starting point of this particular work was two observations about financial crisis. During a severe financial crisis, asset prices collapse at the worst possible time, and that increases the distress of financial institutions. And as the financial institutions get more distressed, they stop participating in asset markets, which puts further downward pressure on asset prices and leads to a downward spiral. Now, these effects are relatively well understood, but we think there is a second aspect of financial crisis, a second ingredient, which is perhaps even more important, and that is the fact that uncertainty tends to go up during these episodes, and that tends to generate a precautionary behavior. Now, let me give you an example of the second ingredient from the recent crisis. During the recent subprime crisis, a relatively small event in subprime markets generated massive counterparty risk and the worst flight to quality episode that we've seen since the Great Depression. Now, the initial shock was small in the sense that initially estimated losses in the subprime market were roughly at the order of magnitude of some daily movements in the stock markets, nothing unheard of. Nonetheless, it generated large dislocations in asset prices and the large recession that we have all suffered. Now, certainly, at the initial stages of the crisis, not every institution was affected, at least not at the same way. Not all the institutions had exposure to the subprime market. But nonetheless, these institutions did not go around their usual arbitrage role. In other words, there was a lot of capital sitting on the sidelines, not arbitraging away the asset price dislocation, which was sort of, to us, which is sort of the most surprising element of the crisis. And we think that one reason could be because maybe these institutions or these investors were now facing greater uncertainty. And that's why they didn't want to use their capital, that's why they couldn't go around their usual arbitrage. A related point is the large government reaction that we have seen during the crisis. There are many policy attempts to put some sort of a floor on asset prices, these loan guarantees and the liquidity injections trying to prop up asset prices and break the perverse feedback loop. And when policymakers announce these policies, they sometimes talk about reestablishing confidence and calm in financial markets. Now, it's not clear what they mean by confidence, but one interpretation is that they're trying to reduce the uncertainty in financial markets. So we think that to understand these episodes and to understand the behavior of market participants and the government, and more importantly, to evaluate the behavior of to evaluate policy, we need to understand the sources of uncertainty and why it goes up at times like this. And that's what we try to do in this paper. We provide a model in which uncertainty suddenly and endogenously increases, and this interacts with asset fire sales. Now, the key ingredients of our model is that the cross exposures that financial institutions have with each other, as David pointed out, and the agent's uncertainty about these cross exposures. In particular, in normal times, financial institutions, which I'm going to refer to as banks for short, need to only know about the financial health of their immediate counterparties, and it's sufficient for them to take the optimal action, optimal investment decision. But as financial distress hits parts of the network, as in the recent crisis, cascades become possible because of the cross exposures. A failure of an institution could lead to the failure of a number of other institutions in a cascade effect. And in this environment, it's not enough to know about the financial health of your immediate counterparty, as it becomes important to know about the financial health of the counterparties of your counterparties. And as the shock gets slightly bigger, it now becomes important to know about the counterparties of the counterparties of your counterparties. And that problem quickly becomes intractable. And that's what increases the bank's uncertainty in our model. And as they are facing now greater uncertainty, they cannot assess whether or not they'll be hitting an indirect hit, they don't participate in asset markets. And that's what leads to fire sales in our model, flight to quality behavior by banks and fire sales. And actually, fire sales in our model also reinforce complexity. Because as assets are sold at fire sale prices, now institutions that are in distress, that must sell assets to generate liquidity, are able to get only very low prices, are able to do that, or they're able to borrow very little against their assets or sell their assets for very cheap, which means that their distress now will become larger, which means that more institutions will go under in a cascade. The cascade will get longer, and that means that the environment will become more complicated. We have to think about more about the counterparties of the counterparties and counterparties. So complexity generates fire sales, which in turn reinforces complexity, so we get the perfect storm. And that's how we get from a relatively small shock a very large event in our environment. Our environment, we also identify a new source of inefficiency, which we call the complexity externality. And I'll talk more about this in a minute, but let me know now that because of this externality, this source of inefficiency, we are able to rationalize a lot of the government reaction that we are seeing during the crisis. The government is able to internalize these inefficiencies that the private agents was not able to. So I want to go a little bit more into the detail of the model. Now, let me say up front that what I'm going to describe is an economic model, which is a very imperfect replica of reality. In fact, we're not trying to replicate reality. Reality is very messy, right? There are many things going on at the same time. We're trying to create a controlled environment and put the features of reality, which we think are relevant for the questions that we are interested in, and understanding this controlled environment, how these features interact, and draw some lessons which we think then will also apply in the messier real world. Right? And this is sort of the path taken by many economic models, and this is a particular example of that. So in our little controlled world, there's going to be 3 dates, 0, 1, and 2. And there's going to be a single good, which I'm going to refer to as the dollar. So there's going to be n players in this model, and they're going to be the banks. And they'll start with a given balance sheet. I'll be more specific about what that balance sheet is in a minute. And they care only about their net worth at day 2. So they need to transfer their net worth at day 0 to day 2. And they can do that through one of 2 investment technologies. First, they can invest their dollars in cash, in which case they get $1 for each dollar invested. Or they can invest their dollars in a more lucrative asset, in which case, for each dollar invested, they get R greater than $1 at day 2. So the asset yields higher returns, but the catch is that the asset is illiquid, in the sense that if the bank is stuck with this asset at date 1, and it needs dollars, it will not get anything. Now, you can think about this cash in this model as corresponding to treasuries or liquid assets that retain their market value during times of distress. And you can think about the asset in this model as, let's say, subprime CDOs or other asset-backed securities that presumably yield a higher return, but they become quite illiquid and they lose their market value during times of distress. Right? And there will be a secondary market at date 0 for these assets. Banks, they have to have some legacy assets which they've bought in the past of these illiquid assets, and they can sell these in the secondary market to get some price P, and then that price cannot exceed the price in the primary market, that can exceed 1. So importantly for the secondary market, we assume that when a bank sells an asset, it's the other banks that are in a similar situation that know how to price and value those assets. Those are the potential buyers. Okay? So the idea is that when a bank sells a complex security, anyone outside the financial system has no idea about how to value that security. It must be another knowledgeable investor inside the system, an institution that will buy that security. Okay? So in fact, we assume that if the security must be sold to an outsider, it will sell at a lower price, what we call P scrap, right? And the price will be somewhere in here, and the exact level of the price will be determined by the demand, by the insiders, by the banks, and that will be determined in equilibrium. Okay? So you can look at this slide and you can ask the question of, banks seem to care about only net worth at day 2, and asset yields a higher return at day 2. Why don't they just invest everything in the asset? And to give away the ending, they do in normal times. In normal times, that's what banks do. They keep their dollars, they put their dollars investments in these illiquid securities, loans, and illiquid assets, and that gets them higher return in the long run. And that's what they do. They do the maturity transformation in the economy. However, in this environment, we are going to consider an abnormal event, a surprise shock, in which case banks will think that they might need dollars at date 1. Right? And in response to this event, their demand will shift from illiquid assets to more liquid assets like treasuries. And that's going to be the flight to quality or the flight to liquidity in our environment. And in our environment, this will generate 2 effects. First of all, in the secondary market, the prices will drop to fire sale levels, and that will be the fire sales. And second, in the primary market, banks will also stop buying assets in the primary market, and the asset issuance in the primary market will fall. What that means is that firms or consumers that are trying to borrow by issuing these assets will not be able to do so. So there's going to be a credit crunch in the real sector. And so recap, the main result will be a shift of banks' demand from illiquid assets to liquid assets, and which will generate fire sales in the secondary market, so it will generate effects in the financial markets, and it will generate real effects because the bank's loans to the real sector will also fall down. Okay? So of course, our contribution will be the precise mechanism by which banks' demand shifts from illiquid assets to liquid assets, and that's what I'm going to describe next. In particular, we assume that banks start with a given particular balance sheet in this environment. So they have these liabilities, debt claims with face value Z held by one other bank. So these are the claims of another bank on this bank. Okay, you can think about the exposures of other banks to this bank. But similarly, this bank itself has claims on another bank, which of the same face value, Z dollars. So these debt claims, cross debt claims, are our modeling way of capturing the cross exposures that we observe in the financial system. You can think of these things as literally as debt claims or other claims that financial institutions have on each other, or you can also think about sort of the exposures that financial institutions have on each other from derivative deals that have with each other and so on. And all of those are in a stylized fashion captured in our framework. In addition to these cross claims, which will be sort of the source of contagion and trouble, banks have a number of legacy assets. These are illiquid assets banks had purchased in the past sitting on their balance sheet. And they have a number of dollars which they can sell their legacy assets or keep, or they can use their dollars to invest in cash or new assets or old assets. And these decisions, what they do with their assets and dollars, will be sort of the main decision that we're going to look at. Now, this is the balance sheet of one bank. But how does the financial system look like? Now, remember, each bank has exposures to one other bank. And that bank has exposures to one other bank, and so on. And we assume that these cross exposures go around the circle and come back to the original bank. So we assume that the financial network is a circle of cross exposures. Of course, the circle is just a simplifying assumption that by abstractability, the results that we're going to emphasize, the complexity, will be perhaps even more important if you assume that the financial network will be even more complex than this. So it's just a simplifying assumption that allows us to see things more clearly. The important assumption that we make is that a generic bank inside the circle, so there is some ordering, and there is a bank here, and that bank does not know the exact ordering. From his point of view, the ordering could be something different. He doesn't know the exact ordering. And so that's a way of capturing the uncertainty about cross exposures. For example, if one of these banks here is Lehman, this bank doesn't know that the bank that has exposures to Lehman is Goldman Sachs or AIG, or JP Morgan. Okay, so it doesn't know how the other banks are ordered around the circle. We're going to allow the bank to know its immediate exposure, so it will know exactly, it will know which bank it has exposures on, but otherwise it will be uncertain about how the rest of the banks have exposures to each other. And that's how we capture sort of the idea that it's very difficult to think about these balance sheets, and they're very opaque, and we have to investigate a lot of assets to assess the financial health and exposures of the institutions, and that's sort of our way of capturing that. And that's an important assumption in the model. Now, here is the shock that we consider in this environment. At date 0, it becomes public. All banks learn that one bank, which we call BJ Bar, but you can call it Lehman or AIG, will need additional liquidity at date 1, which it didn't plan for. So something rare happens. This bank realizes that, or everyone realizes that this bank will make losses of theta dollars at date 1. Now, these losses might spill over to the other banks because they have potentially have exposures to this bank, and might also distress them at date 1. So at date 0, you can think of the date 0 as where the financial system is starting to realize that there's a problem in the subprime market, sort of in the early 2008, for example. And they realize that to prepare for date 1, they can take a precautionary action. In other words, they can in this model, take one of two actions. They can choose action S, which stands for sell, and it sort of stands for selling legacy assets to generate some liquidity, and also it's keeping its dollars in cash. So the bank that chooses S keeps a completely liquid balance sheet. That's the precautionary action. The bank that chooses B, in contrast, keeps its legacy assets, and not only that, it uses its dollars to acquire new illiquid assets. So it keeps a completely illiquid balance sheet. It goes for the return. Okay, it's the aggressive action. So these two actions will capture sort of the relevant trade-off in this economy. Are you acting in a precautionary way or acting in a sort of an aggressive way in the asset markets? And another important assumption is that, remember, banks have this network uncertainty, and we assume that they treat that uncertainty as Knightian uncertainty. And what that means is that banks will act according to the worst-case financial network that they find possible, worst-case scenario. Now, that's an extreme assumption. Our results at the qualitative level go through if we assume, for example, banks have some probability distribution over potential networks and they do some expected utility maximization. The results go through as long as banks are somewhat risk averse. Okay? So the Knightian buys us extreme risk aversion. So it simplifies the analysis and it also amplifies the effects. But we think it's an appropriate assumption for this setting, and here is why. because we think that it's very difficult to assign probabilities to these types of uncertainty. So this type of uncertainty is different than the regular types of risks that banks usually face, which they understand, they can assign probabilities to. It's very hard to assign probability numbers because of complexity to different financial networks that might be possible. And microeconomic theory shows that in these environments in which economic agents don't understand face uncertainty about the risk itself, they actually act in a more risk-averse manner. There are sort of experiments that support this. So in this environment, I think it's appropriate. It's a bit extreme to assume that they act according to the worst-case scenario, but it's reasonable to assume that banks would be more averse to these types of risks which they don't understand, to risks than the risks which they understand. Right? So with that, let me get to the characterization of the model. So we're going to characterize the model one step at a time by bringing in the ingredients one at a time, because we want to illustrate the role played by each ingredient as we bring them in. First of all, we're going to consider a benchmark in which banks understand the financial network. Okay, so a thought experiment. Suppose what would happen if banks understood the financial network. And to keep things simple, so first we'll also keep the prices as given. So we're going to look at the equilibrium in that environment. And we'll also endogenize the price in that environment. And we're going to see that in this environment there cannot be fire sales. So the thought experiment will be useful to illustrate that if banks actually understood the financial network, in a deep financial market like the US, we wouldn't observe the big price dislocations that we have observed. Then we are going to bring in the main ingredient, which is complexity or uncertainty about the financial network. And we're going to shut down the price channel, and we're going to sort of study the basic effect of complexity in this environment. Then we're going to bring the prices, we're going to endogenize the prices, and we're going to show how in this environment uncertainty now leads to fire sales, which didn't happen in the environment without complexity. And we're also going to show the interaction between fire sales and complexity, how fire sales reinforce complexity, and how that in turn reinforces fire sales. So that's where we are going. So let's think about the first mechanical benchmark where banks understand the financial network, and the prices in the secondary market are fixed. Now in this environment, just to analyze the equilibrium, first it's useful for us to relabel the network in a more meaningful way. Remember, banks are organized around the circle. One of the banks, which we call BJ bar, is the distress bank. And we want to label banks according to their distances from this distress bank. In particular, the distress bank itself has distance 0 from itself, because it's the distress bank. Okay? And its neighbor, its immediate neighbor that has a direct exposure to this bank, has distance 1. It's an exposure distance of 1. And the bank that has exposure to the bank that has exposure to this bank has distance 2, and so on. And this way you can provide a unique label for each one of the banks in this network, and that will kind of facilitate the analysis. And once we do that, we can characterize what happens in this economy. Remember, this bank had losses of theta. We'll have losses of theta at date 1. Now it has some ammunition to fight these losses. It can keep its dollars liquid, and it can also sell its assets in the secondary market. And by doing that, it can raise LP dollars of liquidity in our environment. That's what LP is. But if theta is sufficiently large, if theta, the initial shock is sufficiently large, it will not be able to fight the shock in full, and it will go bankrupt nevertheless. Okay? And as it goes bankrupt, it will not pay in full to its neighbor. Some of the losses will propagate to its neighbor that has direct exposures to this bank. And if you actually calculate the liquidity need of the neighbor, you see sort of it's an intuitive expression. It's just theta minus LP. So the initial bank uses some of its internal liquidity to fight the shock, and as the shock migrates to the neighbor, it's diluted a little bit by LP. But if theta is sufficiently large, for example, in particular if theta minus LP is greater than LP, this second bank will also go bankrupt. But as it goes bankrupt, the shock will propagate to the third bank, but as it happens, it will be diluted even more. And you see eventually the shock will be contained. So because each bank uses some of its internal liquidity to fight the shock, there's going to be a number of banks will fail, but then one bank that's sufficiently far away will be able to take the precautionary action and will be able to avoid bankruptcy. Now this bank will suffer some losses. Its equity holders will not get paid in full, but it will be able to avoid bankruptcy, and their holders, its neighbors, will not get paid in full. And the banks that are farther away in the network, that have even greater distances, they're far away from trouble, they'll be safe, they'll not make any losses, and since they don't make any losses, they'll be aggressive in asset markets, they'll buy securities, and that's how the equilibrium is going to look like in this setting. It's going to be a partial cascade. And importantly, the cascade size will be increasing in the size of the initial shock. That's not surprising, right? If the initial shock is larger, more banks will go under. But less obviously,
the cascade size is also decreasing in the price in the secondary market. Why? In other words, the price in the secondary market becomes lower, cascades get longer. And why is that? Remember, these banks fight the cascade by selling assets. And as they sell assets at lower price in the secondary market, they are able to tap less market liquidity. And because of that, they are more distressed, and the shock goes on longer and distresses more banks. Okay? So it's important to keep in mind, I would ask you to remember that, the cascade size, as prices get lower, cascades get longer. That will be an important factor when we come to complexity, when we introduce complexity in the analysis. But in this setting, the second question you can ask is that, well, how do once we endogenize the prices in the secondary market, how do they look? So in this setting, which sort of when banks understand the network, the prices look really good in the secondary market. Because remember, a number of the banks go bankrupt, but the number of banks that go bankrupt is proportional to the size of the initial shock, which we assume is not that large. And we assume this is a very large financial system like the US. It's a deep financial system. And there are lots of banks here. In other words, there are lots of banks here that are far away and is large, and they're willing to buy. They're ready to buy assets in the secondary market. Since they're ready to buy assets, it stabilizes secondary market prices at the primary market price level of 1. In other words, there are no fire sales because there are lots of institutions that are far away from trouble, and they know that they're far away from trouble, and they stabilize prices in the secondary market. Financial markets look pretty good. And so let me skip this picture, which just summarizes what I just said, and let me move on now, introduce the main ingredient, complexity, which will change these results drastically. Now, the key assumption, let me remind you of the key assumption. Each bank observes its immediate exposure, its direct exposure, but it doesn't know how the rest of the banks have exposures to each other. Okay? So I know who my counterpart is, I don't understand my counterparties, and so on. And with that assumption, we get the following. Banks that are very close to the distressed bank, in particular banks that are either the distressed bank or that are just the immediate neighbor of the distressed bank, they know their exact distance, which is the relevant variable in this economy. So if you are Lehman, you know that you are Lehman. If you are right next to, if you are direct exposures to Lehman, you know you have direct exposures to Lehman. So these banks continue to do what they would do in the no alternative benchmark. There is no difference in their action. The difference is in the other banks that are actually farther away. So suppose now we look at the banks that have distance 2 or more from the distressed bank. Now these banks don't know exactly how far they are. They think they could be at distance 2, they could be at distance 3, they could be at distance n-1. They're not sure. And the worst case scenario, they act according to the worst case scenario. And unsurprisingly, the worst case scenario is when they're exactly at distance 2. So they actually replicate the action that the bank with distance 2 would take in the no uncertainty benchmark. Or put it more broadly, the banks that are far away act as if they're closer to trouble than they actually are, because they don't understand there's uncertainty and because they're averse to this type of uncertainty. Okay? And given after this characterization, we have basically two levels of the shock that generate different effects. If the initial shock is sufficiently small, so that there is not much of a cascade. Suppose it's only the initial bank, for example, that fails, and it's not spread to the neighbor. The neighbor is able to deal with it with some loss. Now, in this case, being at distance 2 is not a very bad thing. Because if you're at distance 2, you're still safe. There are no cascades in this economy. In other words, being at distance 2 and being at distance n-1 are pretty much the same thing. So that's why in normal environments or when shocks are small, actually banks don't care about this type of uncertainty about financial network because it doesn't translate into any payoff uncertainty. And for small shocks, banks are able to deal with it, and we are sort of back in the scenario where banks actually, it's as if banks know the financial network, even though they don't, because there are no cascades and that type of information is irrelevant. Okay? So in this environment, obviously, the prices will also be high, and banks will continue to make loans and so on. But now suppose the shock gets a little bigger. So now there's a cascade, and the bank that is at distance 2 suffers some losses. Now there's a huge difference being at distance 2 versus being at distance n-1. If you're at distance 2, you would be caught in a cascade and you would make some losses. But if you're farther away, you wouldn't make losses. But since banks don't know where they are, they act as if they're closer, and they all panic and start selling or start hoarding liquidity. And this generates the sort of the flight to quality episode in our environment. And when the shocks are sufficiently large, if we endogenize prices, obviously this will also generate fire sales in the secondary markets. And now, interestingly, what happens in this environment is, for the intermediate levels of the shock, we get multiple equilibria. In other words, we could either be in this situation or in this situation, and that depends on which asset price in the secondary market agents coordinate on. In particular, suppose prices fall for some reason to fire sale levels. And remember, as the prices are at the fire sale levels, institutions that are in distress are unable to tap market liquidity, so they are more distressed and they go more likely to go bankrupt, and cascades become longer. So the environment becomes more complicated, and that sort of leads to panic by the rest of the financial system, and they stop buying assets, and that in fact keeps prices low in the secondary market, and that sort of this situation becomes an equilibrium. It's sort of it's a consistent description of an economy. Okay? But suppose somehow we are able to increase the prices in the secondary market to their, for example, their fair levels, which are the levels in the primary market. And this would increase the market liquidity that distressed institutions are able to tap, and this would shorten the cascades. But as the cascades become shorter, the environments become simpler. You don't have to anymore think about your neighbors' neighbors and so on. And as the environment becomes simpler, the rest of the financial institutions that are farther away become potential buyers, and that keeps the price in the secondary market high, and that keeps this situation also as an equilibrium, a consistent description of the economy. So it could be either in the one or the other, depending on the actions of the economic agents. And the reason we have that type of multiplicity is actually for a good reason, because of an inefficiency that we identify in this framework, what we call complexity externality. Now, an externality is something that an economic agent does that affects other economic agents, positively or negatively, but that's not taken into account by the action that's by the agent that's doing the action, because that doesn't affect me. Okay? And in particular, in this environment, if an agent takes an action that lengthens the cascade, it makes a great deal of damage to the institutions that don't understand the financial network. It inflicts this type of damage. And how does an agent increase the cascade in this environment? Well, by selling assets. Suppose I'm an institution that's far away, and I panic and I start selling my assets. What I do is, since I sell assets and increase the supply, I put downward pressure on the asset price. And as the asset price gets lower, market liquidity becomes less, and the cascade gets longer, so I'm increasing the cascade at the margin by my action of selling assets in the secondary market. And as the cascade gets larger, it hurts all other institutions in this economy, which I don't take into account. And the bad equilibrium in our environment is essentially a setting situation where all economic agents are kind of inflicting these externalities on each other. They panic and inflict these externalities, so that sort of brings a role for public intervention in this setting. In other words, there's a role for government policy, and the government's role is precisely to reduce complexity, or to reduce this complexity externality that agents are inflicting on each other. And with this framework and with this analysis, we are actually able to support various government interventions that we have seen during the crisis. For example, insulating institutions from counterparty risk, either by bailing them out or bailing out their creditors. In fact, we see that now in the Eurozone, the bailout of Greece and then Ireland and so on. So why is that a good? According to our framework, it's good because it reduces the complexity or uncertainty of the environment, and which sort of has a positive welfare effect on the institutions that don't understand this network. And also supporting secondary markets, these sort of loan guarantees and loan purchases, for example, the type of the quantitative easing that we see, if it spills over to these types of assets, that's a good idea because it raises the prices of these illiquid assets in the secondary markets, and that in turn shortens the cascade and simplifies the environment, again, deals with the complexity externality. And finally, stress testing is also supported with this environment, because by stress testing systemically important institutions, the government is essentially able to generate more information about the financial network. And since the problem is sort of the uncertainty about the network, this type of stress testing in our framework is useful because it reduces the uncertainty, it reduces the problem. Okay? So let me recap what I just said regarding this fireSales and complexity paper. Basically, we have argued that during severe financial crisis, the complexity of the environment rises dramatically. And this in itself causes uncertainty and financial retrenchment. And in our model, it's a very specific sort of source of complexity. We captured complexity of the environment with cross exposures and agents' uncertainty about these cross exposures. However, you could think about, like as David pointed out earlier, you could think about other sources of complexity. It could be that valuing assets becomes sort of more complex and difficult in these environments. And those types of complexity are complementary to our analysis. You could capture similar types of complexity in a similar model, and the effects would be similar. And we also show that complexity and fire sales reinforce each other in our framework. As complexity leads to fire sales, that in turn increases complexity and so on. And that because of that, with relatively small shocks, we get these large crises in fire sales, dislocations in secondary market. And finally, we have identified the complexity externality, a new source of inefficiency that's able to rationalize some of the government reaction we have seen to the crisis. But let me note the caveat, the standard caveat there. Of course, once you are in the crisis, these actions seem reasonable, and in fact, we can actually microfund and provide economic rationale for them. But remember, these actions also generate moral hazard concerns. Institutions, if they expect and anticipate the government to do these kinds of bailout, then they are more inclined to take risk. And of course, those effects are absent from our simplified model. So that's what I meant when I said reality is very complicated, lots of things going on at the same time. You have to take sort of this model is only one piece of reality, and you have to combine it with the other pieces to make your final opinion about the markets and also about policies. So in the remaining time, let me talk briefly about my other research, which is about financial innovation. Now, the traditional view of financial innovation is that new financial securities are useful because they help to diversify the risks, and they also help market participants share the risks. They spread the risk to the agents that are best able to deal with it. But this traditional view overlooks the fact that new securities themselves generate new uncertainties. In particular, these securities don't have a long track record, and they haven't been around for a long time, so there's not much data to think about how these securities would pay off. So it's not clear how to value these securities. So there's sort of an inherent uncertainty in how to value new securities. And these differences of opinion about how to value securities come naturally as a byproduct of this uncertainty. In particular, when there is not much of a track record and when there is not much data, it becomes more easy and more reasonable to believe in your models and to have your own opinions about how to value new securities. And these types of differences of opinion naturally generates betting. But betting is essentially the opposite of risk sharing. Right? So the traditional view emphasizes how new securities enable risk sharing, but if you have this view that they come with sort of this new baggage of new uncertainties that generate difference of opinion, betting, that goes in the opposite direction. In fact, we can sort of give an example of this from the recent crisis as well. Let's think about the subprime CDOs and sort of the CDS contracts on them, which became popular in the run-up to the crisis. Now, these subprime CDOs, you pull a lot of subprime mortgages together and tranche them, and you sell them to different tranches to different investors according to their risk or liquidity appetites. And the idea of this security is a good one. And because the safer tranches are sold to investors that are looking for safety and liquidity, while the riskier tranches are sold to investors that are able to, or institutions that are able to bear those risks at some price. So these securities are in principle supposed to facilitate risk sharing in the economy. But they became a major trigger of the crisis when a fraction of the institutions realized losses on these securities. And more important and more interestingly, another fraction of institutions actually realized gains, profits from their positions on these securities. In other words, this points to some speculation or speculative betting. And actually, how exactly speculative betting happened is very nicely described in a recent popular work of Michael Lewis, The Big Short, and you can read there exactly how the speculation happened in the financial markets. But these observations raise sort of serious doubts about this traditional view of financial innovation, that it always and everywhere reduces the risks in the economy, or stabilizes the economy. So what I do in this work, what I try to do is, I try to build in difference of opinion to a standard model of risk sharing. That actually goes back a long time. That goes back to Lintner and Sharp in 1960s. And I just introduce this additional element of difference of opinion. And I show that with this additional element, actually financial innovation now can be destabilizing, in the sense that it can actually increase the variance, how variable investors' net worths will be in the economy. And then I go on to characterize the kind of conditions under which this is more likely to happen, the kind of securities that are more likely to increase these types of, to generate this stability and so on. But in that, while I do those exercises, I stumbled upon an interesting new effect, which I call the hedge more, bet more effect. And instead of going into the details of this work, actually I would like to talk a bit more about the hedge more, bet more effect, which in my opinion is the most interesting thing about this paper. Now, to understand this effect, let's think about a very simple example. Again, we're kind of constructing a very controlled environment to understand one effect, but understand it well. Okay? So suppose there are two traders. It's a tale of two currency traders. These currency traders disagree about the value of the currency, the Swiss franc, but they don't disagree about the value of the currency, the euro. For example, one of them is optimistic about the Swiss economy, and the other is pessimistic about the Swiss economy, but they don't disagree about the Eurozone overall. It's just about the Swiss economy. That would generate this type of disagreement about the currencies. Now, for a controlled experiment, first suppose they can only trade the franc and not the euro. The only thing that you can do is you can trade the franc. Now, they will take some bets, because one of them is optimistic, the other is pessimistic, and they will decide on their bets according to some standard risk and return trade-off. And importantly, they may choose not to bet too much, because the Swiss franc is a pretty risky asset, especially because it's affected by multiple sources of risks. It's affected by the risks that affect the Swiss economy, as well as the risks that affect the Eurozone, because those assets are highly correlated. So they may choose not to take large positions if they are risk averse for one reason or another. Even though they disagree, they may sort of shy away from taking large bets. Now suppose they can also bet on the euro. Now what these traders are going to do is they're going to hedge their positions in the Swiss franc by taking the opposite positions in the euro. Why? Because they don't disagree about the risks of the euro, and by these opposite positions enable them to hedge out the risks which they don't disagree about, and enable them to take purer bets on the risks or the parts of the franc which they disagree about. Now these purer bets come as sort of like a lower risk per unit bet, and so they look more attractive to these traders. So when they take these opposite positions, they also amplify their bets, and they also amplify their positions. So when they are able to hedge more the risks that they don't care about, they are able to bet more on the risks that they disagree about. Okay? And in fact, the remarkable thing is that I showed this hedge more, bet more effect is sufficiently strong that traders end up holding a riskier portfolio when the euro is available than when the euro is not available. So this amplification effect is sufficiently strong that each trader ends up with a riskier position than before. Of course, each trader thinks that is also earning a handsome expected return that compensates for the additional risk that is taken. But remember, these are traders that are disagreeing, and at most one of them can be right. In fact, you think about sort of a more general economy where there are n traders disagreeing like that, at most one of them can be right, and many of them will be wrong. And so this, this may look good for each one of them because they're more easily gambling on their different views. But this doesn't look good from a systemic point of view because it sort of makes it more likely that a fraction of financial institutions will fail. For example, if their bets turn sour. Okay? Now, related to financial innovation, to this effect, financial innovation, this effect shows that new securities, new financial assets such as the subprime CDOs or the CDSs, not only generate new uncertainties that come with how to value them, but also they enable traders to bet more accurately on their existing disagreements or existing uncertainties. So they unleash the speculative forces, which might have been latent, but before the innovation of these new securities. So this effect, in my opinion, suggests that this crisis may not be the last that we're going to observe in developed economies, unless we do something about it, or unless we regulate the financial markets. And I don't know exactly how to regulate the financial markets, but that's sort of those questions are the kind of questions that I'm thinking about for future research. So let me recap what I said today. I said many things, but the broad theme was that we talked about the sources of uncertainty in financial markets. And in particular, we talked about complexity as a source of uncertainty, a particular type of it captured by cross exposures of the financial institutions. And we also talked about financial innovation as a source of uncertainty. And as a side note, we also talked about the hedge more, bet more effect. And let me also note that it's an active research area. These works are not the only works that identify sources of uncertainty. There are others. And there are also other people now trying to shock the economy with these uncertainty shocks and see how far we can go by these uncertainty shocks to understand, for example, things like the business cycle. So it's a very active research area, and there is much to be done and much to be understood, both in terms of positive and also policy or normative aspects. And thank you very much.
Now Roy will have some policy discussion.
Thanks, Dave. One of the things that I think is important that this paper, you look at it and it's a certainly a very thorough academic paper, but I think it has some real important implications in the real world. I think it's a paper that, you look at the model and it's this, you've got these time zero, time one, time two. It's only about banks. It's only about this one form of complexity. But I think it generalizes into some of the real world issues that we're dealing with. It generalizes certainly with regard to complexity of securities. When you're dealing with that complexity and you're thinking of it in terms of how it affects potential fire sales, that complexity is probably one of the most important reasons why it's hard to find an alternative buyer. Why that you have a situation where, in a sense, you are forced to sell. You are forced to sell at fire sales. That there's not a competitive market to buy the assets that you're trying to sell. So I think that complexity is, in the real world fits very much into the spirit of this model. The other thing is, I think it's just also important, the idea of a fire sale. Is this a hypothetical notion? Is it something that only happens rarely? Does it only happen in situations where we've gotten into some sort of financial distress? The answer, I think, to that is no. And I think these things can be very important, and I think it's very important from the point of view of liquidity risk. I think in any cases where I don't like to use the word fire sale, I want to think of it more as terms of forced sales, or really in today's world where you have longs and shorts, I want to think of it more in terms of forced transactions that you have to make. Those transactions can be made because you need cash. There's a cash flow reason for it. You have to meet your financing. There's some form of financial distress. Okay, that's obviously an important one. A good example of a situation where you saw some relatively dramatic impacts in the market from forced sales, even before the 2008 timeframe. Think back to the quant meltdown in July, August of 2007. Think about a market where a portfolio might have, and this truly happened in some cases. I've seen a portfolio, a friend of mine saw a portfolio where you had on the long side 30 stocks, all relatively liquid, relatively large cap stocks. On the short side, you had 30 different stocks. Again, all relatively liquid, all relatively large cap stocks. On a particular day, now one of the things which was interesting is that, if you look at the index that this was going on, they didn't have any major moves. They were up 1, 2, they weren't up 10 or they weren't down 10 type of days. Okay? But in this portfolio, again, 30 stocks long, 30 stocks short, beta of the portfolio, roughly 1 on both sides. Again, same gross, same net, gross of net of 0, gross 100. Every stock on the long side, all 30, were down that day. I don't even know which way the market went, okay? Same day, every one of the 30 stocks that they were short was up for the day. Now, statistically, any equity model that you look at, that can't happen in. Okay? But it did, and it wasn't just unique to this one particular portfolio. There was something going on in the market. There was forced trading. People were having to unwind positions because they were up against their credit limits. And it had that kind of an impact on the market. Okay? That's one example. Again, it's an example tied to essentially financing requirements. There's a lot of other cases where you can think of business reasons which lead to forced sales. The one that I learned way too intimately about was portfolio insurance. Go back into 1987. Again, for the youngsters out there, portfolio insurance was simply dynamically replicating an option type of payoff. Okay, essentially what you were doing, since they were either replicating, as a full package, the idea was to replicate a call option payoff. Okay, the market, you start with a hedge ratio or a delta. Okay, the market goes up, you buy. The market goes down, you sell, just like with any kind of option replication. Okay, turns out in 1987, people forget, it was a wild year and things were going on, but for the total year, the market was actually up, in spite of what happened in October of 1987. As of the end of August, you look at the major indices, in the U.S., the S&P, the Dow Jones, they were both up roughly 40% for the year. Okay? If you looked at the S&P earnings for the year, January through August, they were flat. This was all multiple expansion, okay? Or the impact of buying stocks over that time period, okay? Obviously, when the things started going the other way, all these options that were, had very high deltas, very high hedge ratios, they were all selling. So when you start getting into something like October 19th, you basically were forced to be selling fast and furious. Now, you weren't, quote, forced, but from a business perspective, you were. You were basically selling a product that was going to provide capital preservation. The only way you provided that capital preservation was to follow through on the replication and to sell as much as you could, even though the prices were falling dramatically. It was an example of essentially what I think of as forced selling. Okay, I'll give you another example, which I think was even a simpler one. Okay, when you advertise what you're going to do, ultimately it can be very costly. Back then I was teaching at University of California, Berkeley, and I was consulting for what was then Wells Fargo Investment Advisors. And we came up with ways of measuring our trading costs. Back then we were doing portfolio trades, which were simply a portfolio of, a good example, we collected the data on we'd be buying 490 stocks, which as a portfolio that had a correlation of 0.999 with the S&P 500. We were essentially didn't buy the whole basket because we were just filling in a little bit from what else we had. But essentially, we were buying the S&P 500. There was no information in the trade. It was pure index. It was money that flowed in. We didn't trade. Okay. The way we were doing it back then was we would basically put this out to the street and we'd say, look, we'll give you 2 hours notice. Line up the position. There's no information in this. Get the best execution you had. But we want to do this at the close. We want to do it at the close because you're always marked relative to the S&P. The best way to minimize any kind of basis point spread, any deviation from the index, was to trade at the close. Those were the prices. You got marked at the close. You bought it at the close. There was as minimal slippage as possible. And we could do it at a pretty cheap price. It was like 2 basis points. Okay? That sounds like a really simple trade. It should be one that, again, S&P 500, there shouldn't be much of a chance for price impact on that. We measured the transaction cost, the price impact of our trades. And the average size of these, by the way, was about $20 to $25 million across a portfolio of 490 stocks. Okay? We were moving the market at the close by 1%. Okay? We moved it because we were telegraphing what we were doing. It was essentially a forced trade. It was forced in the sense that we were trying to do this from a business perspective to minimize tracking error. We changed the way we did it, obviously, after that because we really weren't forced to do this. But again, that's an example of these kind of trades and how they work. Go back to 2009. Come back to some of the more recent time frames. You look at what was and maybe still is, the leading oil ETF. Okay, I'm not going to name it just because I don't want to swing luck, because there wasn't anything they were doing wrong. Yes. But there was a time period in early 2009 that oil prices, remember, had dropped dramatically, and then they started to rise quite a bit. They were up 50% on the year. Now, that's from a base of in the 30s. But the oil price, based on the spot price, was up 50%. Now, this ETF, very simple, very straightforward exposure to oil. You buy the near-term futures contract, and you roll it. It's that simple. You're always in the near-term contract, and you always roll it. Okay? Sounds like a pretty easy trade. Okay, yeah, there may be a little slippage, but turns out there was a point in time, like I said, when you look at the performance of this ETF, and it was over the same time period where the spot oil price was up 50%. It was up 15%. Just the identification of the rolls. If you go back and look at some of the stuff going on during the rolls and the futures contracts in oil at that time, over that period, there was a slippage of, you lost 70% of the 50% of the return, okay? Because you were advertising what you were doing, okay? I don't have any data to present relative to the others, but think of these 3x ETFs. Just give you an example of why you need to be careful with these kind of things. 3x ETF on, okay, let's say the index was up 5%. And there certainly were days when, for example, in the financials or something, there were times when these things were up 5% or down 5%. Say it's up 5%. So in other words, and just make the math simple. I start with 100, it goes to 105 on the index. Now, if I start with a 3x ETF, I start with 300 of the stocks in that, and I have 200 in borrowing. If I go the other side, I'm on 3x short ETF. I have 400 in cash because I've got the proceeds for my short, and I've shorted 300. Okay? At that day, again, both positions essentially cancel out. Neither one of them, I'm long 300, I'm short 300. Okay? Let's say the stocks go, the index is up 5%. So I go from 100 to 105 on the index. Well, I'm not going to go through all the arithmetic for you, but if you do sit down and figure out what that means, because now, tomorrow, I have to buy stocks to replicate my 3 to 1. I have to keep adjusting my portfolio to get to that 3 to 1, both on the long side and on the short side. Well, my long portfolio, with that 5% increase, made 15%, but they got to go out now and buy 30% or $30 worth of the index. The short lost 15%. Well, what do they have to do? They actually have to go out and buy 60% of the index. Okay? They lost. The reason the numbers go that way is they lost money on this. So not only do they have to rebalance for the loss, but they basically also have to then adjust for the fact that they're starting from 85. So the short that they had actually went up in value. So that trade the next day, essentially based on my initial capital of 100 on one side, 100 on the other side, okay, has to buy 90%, okay, of the unit. Goes the other way. Now this isn't just because I did 5%. If you did it at 1%, it still has the same 9 to 1. Okay. If you basically go the other way on the short, again, you'll see that everything flips. So there's all of this trading that has to happen in these contracts. And it's not just that they're canceling out. The longs have to buy, the shorts have to buy on the same day. When it's down, the longs have to sell, the shorts have to sell. So you're seeing all of these kind of potentially forced selling. Now you could say they don't have to do it, but they're advertising from a business model that they're doing 3 to 1. That's the way you maintain that 3 to 1 situation. So again, the whole concept of these forced transactions, I think, are cases that we really need to be concerned about. Okay, they certainly have a major implication or a major impact in some of the markets. That's the first question. Now, from a policy perspective, just because it happens, should we care? I mean, to a certain extent, you can argue that the fact is that if people are losing in some of these cases, they get forced to sell something. That's the brakes. Okay? And in most cases, I probably actually agree with that. The one case that I think, which very much fits in with the paper, is that I don't think you can think of the banks or the financial institutions in the same way. You can't think of situations where you really are worrying about capital adequacy, that you really are worried about the potential impact that insolvent banks can have as part of the process, or insolvent insurance companies, or insolvent investment banks. Okay? So if we're going to have requirements that are related to bank capital requirements, we ought to be thinking about the implications of forced sales or fire sales. And if we want to think about the idea of essentially removing the banks from exposure to, or minimizing their exposure to, these forced sales or fire sales. Doesn't mean the whole system has to. Just means that those things shouldn't be done within the banks. Now, a couple of takeaways, again, from my perspective on Al's paper, which are very simple. But one is that obviously, as all these things, there's a deadweight loss to potential financial distress. That's the way to think of the idea, okay, of the potential ramifications of these rare events. It's essentially keeping investors, or keeping the companies, the banks, from investing in positive net present value transactions. The problem is, and the second point is, the problem is made worse by complexity or the increased uncertainty. Okay, again, Okay, I'm vastly simplifying it, but those are the two things I think are important as part of this. Now, I think there's also two relatively simple solutions to those, or at least things to make those better. Okay, from the point of view, and again, I'm focusing on this from the point of view of capital adequacy. Okay, reducing the likelihood of having to sell. It sounds like, okay, let's raise equity. Okay, make the rare events more rare. Okay, I think the banks have more equity, they don't have to sell. Okay, now you can argue the flip side of that as well, but then I'm not going to be profitable. The thing which I think we all forget as part of this argument is that we have a tendency to focus on, the banks certainly focus on ROE, return on equity. And it's treated as if it's a fixed number. It's this hurdle that I have to beat. Certainly is that case in a lot of the compensation plans for senior executives, is you're paid based on the higher. One of the papers, which I think is very much related to this, is, again, no dominance. Weighted average cost of capital for a firm essentially says that the weighted average cost of capital shouldn't be impacted if there's no impact on the cash flows. No impact on the cash flows, there's no change in the risk. Okay? If that's the case, you need to then say, what is it that leads me to want to have more debt or more equity? What is it that changes that required return on equity as part of this in a way, or this required return on assets? Okay. If there's no change in the required return on assets, then the investment should be good, whether or not I'm 100% equity invested or 90% in debt. Okay? It shouldn't matter. If you think of the two major things that people think about when they change that is tax shields. Okay? Now, from a regulatory perspective, I'm not sure that that's the motivation for of the regulators to let the banks essentially reduce their taxes. But again, that's a possibility. The other side, the flip side of that is cost of financial distress. If I can reduce the cost of financial distress, everything else equal, my required return on assets probably ought to be better. It's less of a dead weight loss. My investment, my cash flows will improve. Okay? So it makes a case that the banks ought to have more equity, not less, and that there shouldn't be this dramatic cost to increasing equity. So again, I think that's a simple solution to this. The second one is with regard to complexity. One of the very simple things that you can do, especially from the banks, is have it such that all of their derivatives, all of these type of securities have to go through clearing, or preferably through an exchange. What's it do? It allows for a much better transparency with regard to how these securities essentially are viewed in terms of what the exposures are. Is the collateral being taken care of? There's certainly much more greater price transparency. There's price discovery. So again, what you've got is the exchange or the clearing is overseeing essentially the position sizes. So things can't get out of line. One of the things which happened with long-term capital was very smart, and they basically got into a situation where their positions were larger than any of their counterparties knew. Because none of their other counterparties, they had lots of prime brokers, they had lots of, they were dealing with everybody on the street, but nobody else knew who else they were dealing with. Okay? With clearing and exchange, you can solve a lot of those problems. So again, I've gone over my time, but basically, the two things that I think you can take away from this is that from a bank perspective, more equity is probably better, and it's a simple solution. From a complexity perspective, greater transparency, certainly greater use of clearing and exchanges. And by the way, just one of the things people talk about with exchange, you can't put illiquid securities on an exchange. Tell that to the people who buy and sell small stocks. Small stocks are traded on exchange. In many cases, they're not eligible for margin, which is the equivalent of a 100% haircut. So what? Some securities, if they're illiquid enough, shouldn't have leverage associated with them. Okay? Second part is, again, we're focusing on the banks. Because to a certain extent...
Or if they're state-dependent enough, they shouldn't have leverage associated.
That's true. I'm thinking all the risks and all the illiquidities. Yeah. you don't need to be worrying about some of these complexities, some of these issues with regard to leverage, some of these issues with regard to potential forced sales outside of the area that can cause potential financial distress to the system. If investors want that added risk with the banks, they can do the leveraging themselves, okay? By doing it that way, they're at least potentially removing themselves from the reasons that we're worried about the banks in terms of providing credit facilitation, from providing essentially the role that the financial institutions are supposed to play and the reason why we think they're too important or too big to fail. Hedge funds fail all the time, okay? It's not, if they want to get forced to liquidate, and lots of them did in 2008 and early 2009, so be it. But that's a separate issue.
We're gonna hold questions. I'm gonna try to give a little more discussion and then give Dr. Simsek a chance to, I notice we've both been furiously taking notes as Roy's been talking, and give him a chance to quickly list some of the things he has, and then we'll open it up for a few questions before closing. So let me say a few things to continue my earlier introductory comments. So we said basically cross claims or bilateral agreements, as well as path-dependent histories or legacy, a history of purchasing and selling certain kinds of assets, right? Because this is a world in which you really don't effectively sell anything, right? If the hedge more bet more, you sell in order to bet more. And hedges are not perfect. So those two things complicate search, and I didn't say what they complicate search for. So they complicate search for credible complementary counterparties, right? All speculative trading includes credit extension. And hedging in that kind of a portfolio is another kind of speculative trading, since hedges tend not to be perfect. Hedges tend to have their own state dependence to them. So here's the underlying themes I hear floating around in the background. There's some Akerlof's lemons in there, right? In the sense that at some point people become uncertain about either agents or the
Very similar. It's really information about the network.
About the network.
Assets, for example.
Right.
The way you could think of it as
Is
a
it-
kind of lemon.
Yeah, because you don't know if your agents are
Lemon
lemons.
or not.
Yeah, right. And your agent might be a lemon because his assets have become, or at least his portfolio has become a lemon because of the way he's combined assets. There's certainly a social externality here in terms of COs and in terms of consumption of either joint liquidity or joint carrying capacity, right? There's certainly the Knightian uncertainty you've mentioned, but this is, under here is the debt capacity and limits of arbitrage, thinking of Schleifer and Mischney, 94, 97, and they just recently did a very nice survey paper in 2010. There is a notion of incomplete contracting, because if there was complete contracting, you wouldn't have the issues, right? Even if the events came up. There's certainly a notion of imperfect information, right? There is a notion of market incompleteness, which is the same thing as imperfect information and incomplete contracting. There is a cost of immediacy here, right? I mean, if you had all the time in the world to search, this wouldn't be a problem. And so there's Alki, there's Demsetz, there's Grossman, there's Stiglitz. There's a conjecture and endogeneity here, and a lack of clearing, right? So there's a notion of, is it going to get worse? If it's going to get worse, then I want to wait to act, if I can wait to act, or I want to act very quickly, depending upon how we're thinking about waiting or not waiting. Here's what I think it's not about. This is not about incentive compatibility. You agree? Okay. It's not about mechanism design. It's not about exposing one's private information. We could do that, but that's not really what it's about. It's not about opportunism and asset substitution. It's not about moral hazard, and it's not about adverse selection, right? It's not about gaming the system. I'm going to actually disagree with something he said. I don't think it's about typical risk aversion. I don't think it's about risk aversion because agents here could have risk-neutral utilities. You're still going to get this effect.
You get it smaller.
But you'll still get it. Yeah. If complexity grows faster, then
That's right.
you're still going to get the same effect.
I think the risk averse, they would just go for the expected utility, in which case they would still invest in these long-run assets. But you're right, you get some effect.
You will get some. It just depends. It really, think about it. If they're risk neutral and the cost of search is a limit, then it just depends on how big the cost of search is, right? If your asset's deteriorating as you wait, then your utility goes down very quickly, right? So I think it's not typical risk aversion. Maybe or maybe not information cascades. At first I thought it wasn't about information cascades in the Big Chinjani et al. Sense. Now I'm not so sure, because there is a heuristic here where you sort of do what your neighbor does in certain states, right? Or in certain conditions.
So we take the information of uncertainty as given. So your knowledge about the network is as given, and it doesn't change. But you could think about extensions of the model where that in turn would deteriorate as well.
Yes. Right.
Well, at the same time, there's a counterforce approach trying to figure out what the network is, but then you have to figure out more things.
And it's not directly about Bayesian learning. It's indirectly about Bayesian learning, right? So in the sense that I think your agents are boundedly rational or procedurally rational in a Simon's sense, since you're going to bring up Carnegie Mellon, in a Simon's and Chicago. Yeah. Did he ever go to MIT? In Simon?
Not that I know of.
There you go. Okay.
Well, we can claim it anyway.
You should. We certainly claim everybody. Chicago claims everybody.
Anybody that
Right.
claims anybody, any Nobel Prize winner that has ever flown over the city of Chicago.
You've gone to the bathroom in the airport, whatever. So, and we admit it. I got the new T-shirt. He's procedurally rational or boundedly rational, and I think in a Simon sense in terms of navigating this complex environment. Okay. So here's what I really think we're talking about. We're talking about price dispersion due to increased search costs and computational limits, resulting from complexity of the landscape in terms of state spaces around types of agents conditioned on their claims and their contracts, or their claims, contracts, and instruments, depending upon how you want to define claims and contracts, or contracts and instruments. So because claims evolve, or cross-claims evolve, and legacy asset values evolve, you have jumps in nonlinearities that result in increased complexity. Is that fair?
That's more than fair.
Okay.
So that's a very, very nice and fresh look of our own work, which I hadn't thought about before.
We'll talk about it at dinner. Please, you got some cool stuff. I want to take notes on what you got to say.
I want to actually start with, I want to thank both of you for excellent remarks, both Roy and David. And let me start with David's comments first. It was a wonderful tour de force of how our work fits with the literature. And in fact, David has highlighted some links, some relations with literature, which I hadn't myself noticed before, so it's actually very useful, and it was extremely useful. Thank you very much. And I want to just kind of emphasize two things that first of all, this is very much about Schleifer and Richter, and let me actually explain it, because that's a very important piece of work. So what this work is about is thinking about fireSales. How can we have fireSales? Okay. So Roy explained more realistically why some institutions or some investors might have to sell certain assets at certain times for one reason or another. You could call them they're distressed, or they're following some portfolio optimization strategy and so on. So they have to sell these assets. They just have to get offload from these balance sheets. And the question becomes, why is it that why is it that other institutions out there around there, or natural buyers who regularly trade in these securities, are not buying? And Schleifer and Michel pointed out that maybe they're not buying because they're distressed simultaneously with the sellers. For example, this makes a lot of sense. We think about a firm trying to sell, let's say, an airline company trying to sell an airplane because of a recession. It's usually the other airline companies that are going to buy it because it's an airplane. And what else are you going to do with an airplane? But if it's a recession, industrial recession, they're going to be distressed simultaneously. So it's likely that the prices will fall because of that. You'll not be able to find suitable buyers because all the potential buyers are simultaneously distressed. Now in our work, actually we also have these potential buyers. When a bank sells a security, it's the other banks that know how to value, have the expertise to buy it. But we emphasize that it's not that they're constrained. It's not that they're all constrained at the same time, because we're talking about a big industry, financial industry, and lots of potential buyers in a deep market like the U.S. But in our work, it's the potential buyers are sidelined because of complexity, not because of their constraint. So that's our contribution with respect to the Schleifer and Michel literature, and recently literature emphasize other reasons why natural buyers are not buying, for example. And you also emphasize incomplete contracting,
And I think that's actually absolutely very important. So once we learn about the cascade, if you could actually contract on it, write sophisticated contracts, insurance contracts. Again, for example, you could say that, oh, if I'm the second bank down the line, then I will get paid. So when you buy an insurance that pays only if I'm the second bank down the line, you could write contracts like that. You'll be able to deal with the situation. But those contracts are difficult to write also precisely because of complexity. It's very hard to describe those types of contracts. You're absolutely right. We have that type of incomplete contracting, which fits well actually in our environment of complexity. And your other points are all very well taken, and thank you very much for establishing those names. And going back to some of the points that Roy raised about policy, and I think it was an excellent discussion relating sort of putting our model more in a sort of a more realistic and also more policy context. And you raised the issue of leverage and deleveraging, and how actually in our model that would certainly help if banks had more equity or more dollars, because that would keep the cascade shorter. But we have actually other reasons to think that having banks having more equity is a good idea, because leverage itself is a bad thing, because when you have leverage, even small losses or small mistakes that you make eat into the equity capital, and since banks need to keep sort of a roughly constant leverage ratio, their asset holdings now need to shrink disproportionately. Sort of a unit loss in assets now have a disproportionate effect on the bank's investments, and that's a bad thing to the extent that banks play a special role. There are firms and consumers out there that rely on bank financing will get affected by banks deleveraging. So there are other reasons, and you can come up with other reasons. There are other economic theories that explain why leverage. And so I agree with you that I think sort of increasing the capital requirement for banks in general is a good idea given the sort of state of knowledge we have. And you also talked about clearinghouse and exchange, an excellent point, I think. To the extent that we can move these securities to exchanges, then I think we should do that. And I'm not sure how it's feasible if it's feasible for all security classes, but certainly there's talk of moving the CDSs, for example, to the exchange, which would be very useful for two reasons. First of all, it will reduce the cross exposure, so you will have exposure to just the central counterparty, so it reduces the network uncertainty. There's no network essentially, there's only this counterparty and you. Of course, there's a problem of what happens when the counterparty fails, but if the counterparty is sufficiently capitalized, then that doesn't become any problem. But second, it also clarifies that it brings the transparency, which I think was the missing ingredient, missing thing during this crisis. Even the policymakers did not know much about the positions. For example, part of the reason they had to bail out Bear Stearns because the Federal Reserve didn't understand, was not the regulator of Bear Stearns, didn't understand the positions and the exposures of Bear. So it will be very useful. In fact, even besides the counterparty, it will be useful for the policymakers to collect this type of information. And some other countries like Germany actually had better information during the crisis, and they could actually simulate bank failures and see what would happen. And so, the kind of exercise that were not available to the U.S. policymakers. And let me stop there and get any questions that you might have. Thank you very much.
Yes, thank you very much. Hi, my name is Andrea Pistorson. Actually, I'm a bank analyst. So I was really intrigued to hear your comments and policy support for increased capital, because I've been saying this for about 10 or 15 years, and Josh Rosner and I are probably some of the few people publicly early on. But let me ask you a question. Why, if you think that it's important to raise bank capital, but the methods of doing it painlessly are something that get resistance? And my concerns are with over-the-counter derivatives contracting and the fair value of this stuff. And you need rising markets in order for the bank to shadow a balance sheet. This restates, that if you want to immunize the banks from doing the buying and selling that they want to do, you have to eliminate or minimize the amount of fair value that they have to do with the balance sheet. The balance sheet circles a drain in a market correction. So the painless way would be either to minimize over-the-counter derivatives contracting. I'm curious on your opinions about this, but I think they're already, but I don't want to put words in your mouth. So to minimize that, so that you don't have the fair valuation of this stuff, you don't have a bank balance sheet that's just moving because the hedges really don't offset properly. And in turn, you have better quality bank activities such as lending, which you then have real interest income running through the income statement. You don't have a gaming of the income statement or an inflating of the balance sheet that you do get with the over-the-counter derivatives contracting and the non-cash fair value gains running through the income statement. So you're minimizing the inflating because you're doing real loans and or real trading business to generate fee income. It should realize the cash. This is painless if you're profitable and the business realizes cash. If you have a shrinking economy and/or you have agency abuse.
So I think, let me try to rephrase your question.
I don't take the rational agency
Right.
thing at all. I
Yeah.
think
So-
this is why you have supervision.
So let me rephrase your question. It sounds to me like your question's got a couple of elements in it, right? One element is the notion of transparency coming through exchanges and the clearinghouses. The other side, and some standardization of contracts. And I think the other side has got to do with something that we have seen movements toward, which is separating banks from prop trading so that banks become more of the sort of traditional market maker and less of a prop trader. So,
Or eliminate this Commodity Futures Modernization Act ability to trade these things. Because that's what legitimized that, and this is with the plume in the contracts. I actually would cease and desist the contract.
so let's keep it simple. So I think you said something about the clearinghouse. You might want to address that. And then this notion of if you don't have a prop desk, what happens to hedge more, bet more? And then Roy, if you care to weigh in as well, that would be great.
Okay, so I think it was an excellent question. So I agree with you, banks' balances are very complicated. It makes it difficult both for policymakers and for potential investors thinking about. And that might be the reason why they are unable to raise equity, because you need to understand the value of whereas the debt seems safer and so on. That might be related to the agency problems. Perhaps you get sort of additional effects by simplifying and creating transparency on banks' balance sheets. And I also take your point that it's sort of there's resistance to painless ways of raising equity, and there might be sort of reasons for that. I mean, raising equity has never been very easy, and that's kind of why, for example, debt is one reason is the tax advantage. The other reason is sort of information insensitivity of debt, which makes it easier. And also there are sort of control theories. Debt holders can once your debt expires, you can sort of stop financing. That kind of disciplines the management and so on. So there are sort of good reasons why banks raise that. So it's very difficult. And so my intuition, though, my hunch is that there are also some bad reasons why they raise that. They don't take into account sort of the kind of effects that would have on their creditors and on sort of the kind when they get the shocks, they don't take into effect when they have to deleverage the adverse effects on the economy. So it's very hard to disentangle. So I think in net, though, I think there's some reason to think that there should be regulation and increase in capital requirements. Actually, you see, there's still sort of now the Switzerland is doing the cocoa bonds, sort of asking their financial institutions to raise these cocoa bonds, which is somewhere between that and equity. It converts to equity if the value falls to a threshold. So that could be sort of the way to go, because maybe that's sort of like the sweet spot where you're still making it easier for financiers to invest and easier for banks to raise, but you're still also making sure that there's not going to be much deleveraging during the crisis. So there's another way to think about this.
I think by themselves, though, those things are really difficult to value, just like liquidity options are difficult to value. But
we can have a whole.
That's a whole other night. Why don't you go ahead?
I just had one quick question. Is I don't think it's painless for individual banks to not have the over-the-counter derivatives because they've been so damn profitable. They've made a lot of money
It's a
out
serious
of
gravy train.
and it's but it's not. It's in some ways it's no different than what happened when you had price discovery and easy access to prices. I used to see a point taken out of a government bond trade on the Solomon Brothers desk because nobody else had screens. So that's a great source of profit. So for individual banks, I think the contracts themselves providing can be very useful. I think that making them more transparent, making better price discovery will be better.
Alfred, it's a very, very interesting model. I'd like to get a better idea in terms of what your thoughts are of comparing two different worlds. One world is one in which we have exchanges, we have low transparency. We also have certain parts that are not transparent. So that's world number one. Let's call it close to the current world. Then you have a second world out there in which you don't have the transparency of exchanges. You go back and you could think of it either as a private equity or a real estate market or something like that. You remove the internet, you remove other sources of information. Now, what exactly happens to your model if you have World 1 versus World 2? Do things just happen slower in World 2? Do they have, or is there a qualitative difference in terms of what's happened, in terms of size of shocks that become catastrophic, et cetera, et cetera?
So, a very interesting question, sort of, brings kind of different thoughts. I think one thing that would happen, my guess is that given that things are happening slower and things are non-transparent to begin with, banks don't have this kind of sense of confidence, or the market agents, and they don't take these large positions, and they're unlikely. We're less likely to get into this kind of situation. Perhaps there is less financial activity in the second world, but then it's also less likely that we get into this situation, even though there's a lot of sort of non-transparency and there's sort of we don't have the kind of fast transactions that we have right now. That's as a silver lining. When unexpected things happen, things don't look very bad. Of course, in World 1, we have this kind of like a sense of confidence, like we can do things very fast in normal times and trade over the counter and exchange, but then that kind of complexity, which helps us and sort of brings to some extent transparency and helps in normal times, backfires. That's sort of one way I could interpret. Of course, I need to write down the model and think more carefully, but that's the first thought that comes to me. It also reminds me of something that Ben Holmstrom, which is a professor at MIT, is a very good economic theorist and writes about financial issues and crisis. And he always sort of talks about how, so basically liquidity is about symmetric information. Everyone kind of knowing the same thing. That's when markets are liquid. So if I'm trading with you, if we both know the same thing about the asset quality, I'm not worried, so I can buy from you. But then he goes on to say that, well, this could happen in two cases. Either we both know everything, or we know nothing. So if you know nothing, then that's also a pretty liquid market, because I'm not worried that you are giving me a bad stuff, because you know nothing either. So I'm willing to buy it from you. And he gives the example of sort of the De Beers diamond company. Sort of De Beers, when they sell diamonds, they put their diamonds in a bag, and you have to buy the bag. You have to trust the De Beers. You cannot look and handpick the diamonds. And so the idea is that if people could handpick, then this would make the other buyers who are going to buy later nervous, that the people who came before me picked the good ones, I'm only left with the bad diamonds. So it's not that bad when you have no one really knowing anything. So you can think about the subprime CDOs. Before the crisis, it was a situation where no one really understood how much this stuff was worth. They were just trading fast, and you could buy it, and the market seemed liquid. You could just sell it the next year. And when the crisis came, all of a sudden we realized that these mortgages defaulted, and these sort of the CDOs, the tranches of the CDOs, which were insensitive to information, became now sensitive. Now we have to think about the value of these things, and that made trade really difficult, and that led to that's sort of another theory of why we had such a reduction in trade in the securities backed by these mortgages and other assets. So there's another thing that reminds me. It's the second world where we don't know anything could be sort of akin to the earlier stages of the crisis, where we didn't think much about how things were.
That's interesting, because that comes kind of to like this concept of block booking of movies, right? You put a crappy movie in with a bunch of movies that people think are going to be good, and so they buy the block until you get to a world where everybody just says, you know what, they're all going to be crappy movies, right? Or we're not sure how bad the crappy movie's going to be. So, if you want to, that's another one of these worlds where you've got this sort of Akerlof regime, and then you've got these other regimes on the outside. And as long as if you can contract to stay out of the Akerlof regime, right, and you can go into a world where, you're right, you either have complete transparency or you have complete ignorance, right? Or and maybe block booking isn't really about complete ignorance,
the danger to the system and the non-stationarity of the system is when you change from one to the other. And the other, I think a lot of this relates to the time dimension, because in most cases, the time dimension, if things are moving quickly, essentially you don't have to need time to adapt and collect new information. When you get into a situation where there's distress, all of a sudden, you're against the gun. In some ways, the policy, the Fed and the Treasury, what they were trying to do was buy time, and to allow essentially to get more information, to let the participants get more information. Essentially, because you think about one of the examples that is in the model that you can kind of question is the whole idea of the participants take this view of the worst case scenario. Okay? If frankly, in the cases where you deal with it, think about what happened in 2008. That's exactly what people did. You basically, and the best example of it was think about what was happening in the money markets, where essentially, there wasn't an interest rate that would, given the uncertainty that you had with regard to the counterparties, that would allow you to make a loan for a few days because you're making that interest rate for only a few days, and you're risking your principal, and you were potentially risking all of your principal over that time period. So in a sense, you had to assume the worst case scenario because the risk rewards under that circumstance, you know, the bad scenarios are much worse than the potential benefits. Again, you can't get a market clearing interest rate in that kind of a time frame.
And, I mean, another way to think about it is in terms of an optimal stopping question or a Coase question, right? So a Coase conjecture kind of question, right? Or a prisoner's dilemma, repeated game, right? The reason block booking works in that ignorance environment is because you believe that the game's going to continue to be repeated, right? But as soon as you end up in a bad environment where you don't think the game might get repeated because of ruin, because of distress, then all of a sudden everybody goes to the prisoner's dilemma, right? And you don't know how long the pain's going to last, so you continue to kind of hold out.
We're running over time, and a stopping question would be a good point to stop.
Let's see if I'm going to just go. Is there one more short question? If the question's not short, we're not going to take it. I'm going to cut the first one off. Are we good? We're set? Thank you.